Welcome to Hot Sectors with me, Punita Kumar Sinha. Here we take a 360-degree view of the sectors that have seen policy initiatives and analyze the challenges and investment opportunities that lie in them. Today we look at India's infrastructure sector, which is vital to India's growth and development. I'm joined by K. Venkatesh of L&T, Rajiv Lal of IDFC and Vibhav Kapoor of Island Affairs to discuss just that. I have with me K. Venkatesh, MD and CEO of L&T Infrastructure Development Projects Limited. Venkatesh, thank you so much for joining us today. Venkatesh, let me begin by asking you, what is your view on the recent push on reforms in the infrastructure sector?
There have been some bits and pieces of reforms in terms of withholding tax reduction to facilitate alternative instruments being raised abroad. Some reforms in terms of the overseas debt raising being liberalized. Some reforms in terms of forming that cabinet committee for investment, and so on. The place where infrastructure sector is poised today is mainly because of slowdown in implementation and slowdown in bidding, and of course the issue of capital, both equity and debt. So if you see, I have more or less covered the four pillars of infrastructure sector growth. And substantial reforms in each of these pillars needs to be introduced, keeping in mind the current state of affairs.
Now, new project announcements have been in a declining trend. Do you think the current announcements are enough to reverse this trend? Do you see the investment cycle picking up?
It's a very wide-ranging spectrum of recommendations. Let's start on the capital side. It needs a substantially larger window and a longer sustainable tax status. The postponement of GAAR to 2016 is certainly extremely useful, but more importantly, there would be a certain need to reintroduce what was earlier 1023G, which is a certain amount of exemption from total income on interest being paid, interest being received by the banks, as well as capital gains tax on sale of shares. It was there about 5 years ago, and then it was withdrawn. On the debt side, just to give you a perspective of numbers, if you look at the next 5-year plan, we need to raise about $490 billion in terms of capital to fulfill the private sector target of 48%. Now, $490 billion, even if you take an 80% achievement, it would be about $340 billion, requiring more than $100 billion as equity and about $250 billion as debt. So if you really see a current market cap of all infrastructure companies put together, and if you exclude telecom from it, it would be about $45 billion. So you see the amount of capital that you need to raise is substantial, which means the existing developers have to churn their capital, which means you make brownfield assets attractive, and you need risk capital to come in for the greenfield assets. Now, how do you encourage capital is something that needs to be thought through, and that can only come through better agreements, more consistency in tax laws, and a rationalization across the sector in terms of all the finance-related issues. As far as debt is concerned, a lot of work is being done to formulate debt funds. They have to be put into practice.
Venkatesh, where are the trends most positive for a capex revival? Ports, roads, railways, or what else?
One is where the trends are most positive, and the other is what are the low-hanging fruits. In my opinion, roads and bridges, railways, MRTS, that is mass rapid transit, and power transmission and distribution are perhaps the quickest to start off in that order, actually. As far as power generation is concerned, there's a lot of incomplete capacity. And I think if those capacities get completed and the new projects kick off towards the latter half of the 12th five-year plan, then I think you'll see a lot of traction in generation as well. So, the real move has to be in two parts. One is to take stock of why projects have slowed down and which are the projects that have slowed down, and give them a huge push so that you get on to the growth curve. In the meanwhile, parallelly, don't repeat the same mistakes that you've made as to the reason why these projects slowed down. And that, I think, should be the mantra for success.
As you know, stalled projects keep inching up. And a typical infrastructure project requires approval from 19 ministries and takes 24 months to execute. Will the creation of CCI really change that?
It will certainly help, but it depends on 3-4 factors. One is, how do we get traction between the state and the center? The second is, I've gone through the objectives of CCI. Now, they are very wide-ranging objectives, starting from policy-making issues to monitoring, to fixing clearance challenges and so on. So how do you get the traction going between the center and the state on all these matters? So that's the second thing. The other aspect that I see is that how do you link the CCI with the financial sector improvements that need to take place between the RBI, the Ministry of Finance, the banks, the developmental institutions, and how do you represent a common face to the capital that has to come into the country from overseas? Because we certainly need a certain substantial amount of equity to come in and a reasonable amount of debt to come in, keeping in mind the other factors of the economy.
Now, given increased competition, pricing and margins have been under pressure. What is your view on the profitability of the infrastructure space and whether that's likely to improve going forward?
Let me answer your question in two parts, because one is construction profits or supply profits. If you look at project implementation, what is the profit that comes out of project implementation to the agencies that are either building or supplying equipment to these sectors? Now there, I don't see profit margins coming down, and I'll tell you why. The sheer demand for this kind of stuff, and if it takes off the way we have been discussing, margins will not come down. But if there is continued slowdown, in which case supply will exceed demand, margins will be under pressure. And on the developer side, which is reflected by IRRs and valuations, the same theory applies to some extent. But more importantly, I think there are so many other factors into play that come into play. That is ease of implementation of projects, so that you keep your interest during construction and escalation under control, and also the cost of debt and the cost of equity. So there, I think we will continue to be under pressure for at least another 1.5 to 2 years.
In the various sub-segments of the infrastructure space, where do you see better returns and therefore will bid for new projects?
Well, I don't see any difficulty in any of the sectors except maybe irrigation, which is about 9% of the plan outlay. The margins will be under stress because of a lot of local competition, and invariably large players do not come into irrigation projects. Telecom has its own complexities in terms of equipment as well as installation. So I guess that's another area where I won't be able to comment, but I guess that's another area to be seen. Roads and bridges, which is 17% as given in the plan outlay, would see normal profit margins and IRRs. Railways is a completely new sector, so for expansion, I mean, it's an old sector, but substantial growth coming in from this sector, which is expected. That, I think, will give good opportunities for large companies. Power generation, well, I think, it's going to be under stress till those issues relating to fuel supply, etc. are worked out.
Thank you very much for your insights, Venkatesh. We will go in for a short break right here, but once we return, we will be joined by Rajiv Lal of IDFC to discuss how investors and lenders are looking at investments in the infrastructure sector. Stay tuned.